Hi, I'm Dave Dinkle, and today I want to talk about hard money lender scams. When an investor has little or no money and he wants to rehab a property or hold it as a rental, he often initially turns to a hard money lender for the money. I participated in over 10,000 closings, and from my own personal experience, I can attest to the fact that over 40% of hard money loans do not close. I'll show you why in a minute. I literally get calls every week from investors looking to do a hard money loan whose previous hard money loan had failed literally almost at the closing table. Unfortunately, this loan failure is often after the investor has been led to believe that the hard money lender is moving to the closing to fund the transaction. One shocked investor told me he had 59 emails from a proposed lender saying everything was on schedule to close, but the day before the closing, the lender said his managing underwriter said no to the loan. No reason given, except that on further review he suddenly didn't qualify. He had prepaid the lender $15,000 for an origination fee, which was 5% of the amount of the loan he expected to receive. Of course, he was told no refunds are allowed if he didn't qualify. So what I'm going to do here is take a quick review of hard money lenders' deceptive business practices with emphasis on prevailing scams that are happening right now in the industry. So here's a simple pre-qualifying question that you need to ask to the potential hard money lender you're going to be working with. I'll go over this again and give you some other prerequisites and so on. If I borrow $100,000, how much do I have to bring to the closing table, including all my fees and my percentage requirement? Now this is sort of a catch-22 because if you go in to buy the property at $120,000 and the lender is going to loan you $100,000, this is exactly applicable. You're going to have to bring in $20,000 for the difference in the 100 to the 120 plus these fees. So this is a very honest, straightforward question that you should get a simple answer on, and it should be straightforward. If the lender hem-haws around about, well, we have to talk about prices and things like this, go ahead and talk about it. Give him a specific price. Ask him how much his fees are going to be, and you'll see why in a moment. When I talk about standard and junk fees, these are fees you're going to have to pay, which many times are not obvious to the borrower yourself until you get to the closing table and start reviewing the HUD, closing statement, the ALTA, CD, or whatever it's going to be called. You don't see them until it's, quote, too late. So the lender's fee or application fee are pretty standard. They can be the same thing or they can be different. Processing fee. Again, are these junk fees? Are they real fees? Look, they're a hard cost to the lender. How much processing he actually does, it depends on, how hard he looks at it. But he has to look at the same amount of processing for every loan. Not going to get into the details, but obviously he has to check the chain of title of the property to make sure that the seller is legitimate. And in fact, you are a legitimate borrower and buyer of the property. A document prep fee. Now, these things are sort of standard because he has a lot of documents that he puts together as his standard closing package, as you'll find out when you go to have to sign them. How much can this fee be? It can be anywhere from $500 to $5,000, depending on the property and how much he thinks he can charge you at the last minute. Credit review fee. You shouldn't have to pay for a credit report, even though he's going to pull a credit report, because in today's hard money lending world, your credit's important. And as important or more so is how many rehabs have you done to date, or how many rental properties do you already own? Origination fee. Now this is really very, very standard, and it can be the same thing as a lender's fee. It could be in addition to a lender's fee. Flood tax and insurance certification fee. Well, these are all things that have to be done. They should be under the processing fee. But again, they can be charged as an extra fee. An inspection fee. Now the interesting part about the inspection fee is oftentimes they're not even done, except as a cursory drive-by, or done by a realtor, not necessarily an inspection person. But if it's done properly, that inspection fee can be expensive in the sense that it could be anywhere from $250 to $500 or $1,000. I have seen an inspection fee that actually cost the hard money lender $350 that he marked up to $3,500 for a single family home that was 1,100 square feet. So these fees are not passed on or created as a direct cost to you. They're decided based on your credit history as well as your rehab experience, and they're adjustable. And I say on and on here because I've seen 23 different types of what I call junk fees, because that's a profit center for the hard money lender. And those are anywhere from 3 to 6% or more. Years ago, there was a company that advertised, we will loan you money directly for only 5%. And as you went to get the loan signed, they charge you 10% as an origination fee. And yes, they did charge 5% after that, but the loan was only good for 6 months. These hard money loans have terms, either 6 months or 1 year. It's very important to find out whether you have a 6 month or 1 year term of the loan. So I say this, don't get caught up in going with what seems like a low interest rate and have the true cost to be much higher when you include the lender's fees. For example, I see lenders, hard money lenders, advertising today 6%, 7%, 8%, 9%, when most other hard money lenders are charging anywhere between 12 and 15%. Depends on where you are in the country and so on and so forth. So most investors would gravitate to the guy, why should I pay 12% when in fact I can pay 7% or 8%? The reason is that 12% guy may only have 2 or 3 points closing cost, whereas the other guy may have 5 or 6 or 8% closing cost. And what is that? 1% per month over 6 months increases your loan cost by that amount, and he collects that up front. If you're actually also borrowing money for the rehab, you're going to pay points on the rehab funds even though you don't receive them until later, if at all. So be very, very careful. I mentioned to you that I do thousands of closings, and what I see is here are the most common reasons that lenders don't close. How am I involved? I'm not a hard money lender. I do same day double closings with transactional funding. So I fund 100% of the A to B leg. What it's called on the HUD or the closing statement is the amount due from the borrower. So I fund everything there, including the closing cost, except the earnest money deposit if it's been paid previously. On the B2C side, the end buyer, your end buyer as the investor, if you're doing a same-day wholesale double closing, comes into the closing with a hard money lender in hand. As soon as I hear that, I cringe because I know that at least 40% of the time, and oftentimes more, the end buyer is not going to be able to close. And I'm going to give you the reasons that I hear most often. The problem here is everybody's a loser in the transaction. If the end buyer had spent a little more time pre-qualifying how much money he had to bring or whatever to closing, more of these deals would actually close. So the most common reason I hear is the hard money lender says, yes, I agree to 90%, but now I can only do 75%. He has various excuses, all of which means you need more money to come to closing. Now, in this transactional funding that we're sitting there waiting on to complete, the end buyer may not have additional funds. For example, if the original amount of the loan was $90,000, now the borrower has to put up an additional $15,000. Does he have an additional $15,000? Very oftentimes he doesn't. Again, I'm dealing with $100,000 as a framework here. This could be $400,000, $800,000, could be $1 million and change. The issue here is this sudden change of the amount needed isn't really justified for any reason other than the hard money lender decided to squeeze you at the close. Why would he do that? Why would he invest the time? Because he may have gotten another loan where he can use his money to fund something else where he can make more money. So in effect, he's saying to you, come in, make it more stable for me, or I'm going to take this other loan without actually saying it to you. This one is very common. Appraisal came back too low. Now, why did an appraisal come back so close to closing? Why didn't you get that way back when you started? And I'm not even sure that these appraisals are ever even really done. Because remember, whoever pays for the appraisal gets to keep the appraisal. You don't have to give it to the next guy coming along. If you have an inspection report, you don't have to give that to the agent because you canceled. None of that's true. You paid for it. You own it. Now, simply, it's taken too long and we're moving on. Probably means he has another borrower who's in place and ready to go, and he's tired of waiting on whatever you need to get together, which is typically a chain of title issue. It's not to do with you. It's something you didn't know about and that the closing agent actually uncovered. You'll need more rehab funds. How much do you have? Well, that's an open-ended question. What he's saying is, I'm not going to loan you as much as I thought I would because the appraisal came in lower. My contractor said it was going to cost more money. I just had a situation where they're lending the investor rehabber $160,000, but they're also refining me out of the loan that I have on the property, but they don't want to pay me the full amount. So they're squeezing the investor rehabber into taking less money or having me take a reduction in principal and taking a second position, all of which is uncomfortable for everybody except the hard money lender. Now, here's the thing I have to say to you. They never really intended to close and just collect fees. And when I say that, what comes to mind, there's two types of hard money lenders. One that actually attempts to get your loan you need. There are a lot of national hard money lenders that have pretty strict requirements, one of which is you have to have credit, you have to have a history of rehabs. They can be very favorable with lower interest rates, lower closing costs for you, but you have to qualify. In most cases, what you do is you're going to run out and try and find a hard money lender. You go to Google your local RIA, Real Estate Investor Association, look under their vendor list, pull those guys up, and boom, that's where you start. Now, this doesn't mean he won't squeeze you, even though he's a good guy, so to speak. At the very last minute, he may say, I need more money. You have to bring this to closing. Again, these are called predatory lenders, and that doesn't mean they're evil people. I'm not disparaging hard money lenders at all, just the guys that are criminals. They all have to make a living, and they all take massive risk with the money. Oh yes, they can foreclose, so on and so forth, but it's costly. I've stopped doing hard money lending, one of which I just completed a 4-year foreclosure process. Now, if you say to yourself, Dave, that's stupid. There's nobody that takes 4 years to do a foreclosure. Well, trust me, I have some of those brilliant attorneys on my staff that anybody has. And you talk about motions to the court, we did hundreds. And they were all responded to by the other sides as a commercial property. And it goes on and on and on. It's a story of who has the most money and who can wait long enough. Well, I waited him out. Took 4 years, got the property back, actually made a substantial profit on it. But for the average investor, it's not going to happen. When they hear the word sue or attorney, they just kind of cringe and they get goosebumps. Now, the second type proposes to be a hard money lender, but actually is only concerned with collecting fees before the closing. He may not be licensed. He may not have any money at all. That doesn't bother him. He's going to tell you he's a private lender, lending his own money. He makes all the decisions, and he's going to say, I will give you 8%, for example. How much are my closing costs? Your closing costs are only going to be 2%, but you have to pay me the origination fee now, and I'll give you a credit on the closing. So I want to talk about how do you find reputable hard money lenders. They're out there, they're real people. If they've been in the business a long time, typically they will loan some of their own money, and they have investors who put money in. So they can handle size and quantity and so on. Ask for referrals and don't stop with just one. Interview your prospective lender. And one of the most important questions to interview him with is, how much do I have to bring to closing for a $100,000 loan, including all closing costs and my participation? And again, he's going to give you some rhetoric about, well, how much do you have for rehabbing, or am I lending you the rehabbing? How much is the rehabbing? Take the questions one bite at a time and answer them as you go along. I don't need rehab costs, or I do need an estimate of $20,000. He may say to you, can you show me the estimate? He's not going to start lending you money where you go crazy. Let's say that you estimate the actual repairs to be $25,000, you're asking for $70,000. Well, wait a minute. What's the difference between 25 and 70? He looks at it and says, what is this? Well, look, I take a $6,000 a month salary. That's what the difference is. No, he's not going to start giving you a salary while you're waiting for the work to be done by other people. Even if you do it yourself, he's probably not going to loan you the money. Never, ever pay the prospective lender any fees up front, even if he says they're going to be credited back on closing. And they could be credited back on closing, but what happens if you don't close? Remember the example I gave you in the beginning about a $15,000 loss because it didn't close? Now, I mentioned to you I get calls on a weekly basis from investors who said, it's not closing on my end buyer. What's going to happen to my A to B leg? Well, you've lost your A to B leg unless you can find somebody else that's a hard money lender that will fund it for you, which is almost never the case. So the other ones that I hear about are losses, I'm going to say as for as little as $1,000, which is no small loss, up to $5,000 or $6,000 or $8,000. So the $15,000 one was abnormally high. That was simply because the investor was a novice and didn't know how to pre-qualify hard money lenders. So make sure you understand how long your loan is for and what happens if you need to extend it. I just saw the term sheet from a hard money lender, and it was for 6 months, which is one of the standard either 6 months or 1-year loans. But at the end of 6 months, the cost to extend it was 2 points, plus the interest rate went up on the loan from that time forward. Now, if you're absolutely positively sure that you can do your rehab in 30 or 60 days, and your loan time period is for 6 months, be careful anyway. When you do rehabs, anything can go wrong, and it always will. Labor, materials, permitting, and on and on and on. And oh, by the way, then you have to sell it. And every day you hold it, you're losing money because of the hard money loan cost and so on. So I'm saying this one more time. No upfront money for any lender. Now, if you happen to go to a national bank, a credit union, or something like that, and they say we have a doc prep fee, a loan fee, an upfront application fee, or something like that, just tell them to put it on the closing statement. They'll be glad to do that for you. Or find another lender. When you're paying fees up front, it doesn't mean you're going to get the loan. It only means you're going to lose more money if it gets to that stage. The unfortunate problem with loan scams is you don't find out until you're at the closing table oftentimes, or maybe if you're lucky 1 or 2 days beforehand. Certainly not enough time to go out and find another lender to do the closing. Now, some things may be required, like a survey. A lender may say, I want a survey. Well, the property's been there for 70 years or 80 years. Why would you need a survey? It's part of their due diligence, and that survey needs to be paid. Who's going to pay it? Typically, they're going to pass that cost on to you, but you're going to pay the survey person directly. You're not going to be paying them on the HUD later, where they mark it up from, say, $300 to $500. Now, they're going to pay for the inspection report because they're the one that wants to do it. You should be there when the inspection report is being done to make sure it's even being done. I had a closing where the end buyer was a hedge fund. The investor had a $53,000 profit going into it. They came back the day of closing and said our inspector went out there, did his inspection, and came back with an estimate of repairs of $30-some thousand, which took his spread from that to it wound up being only a $1,200 profit. How could that happen? As it turned out, the inspector never went to the property. We knew that because it was locked and he would have had to call to get in. So he never saw the interior of the property, which is what his inspection was all about. So in closing, what I want to say to you is very important. I want you to assign any contract that you can. It's pretty unusual for a transactional funder to say assign the contracts. But I want you to make the most money you can in every deal you do. Real estate is a renewable resource. It opens itself up to constant problems for homeowners. Foreclosures, tax deed sales, bankruptcy, divorce, probates, on and on and on. We help people solve those problems and we get paid very well for it. And if you have a contract and you don't have a good buyer's list, you're going to be taking small profits. And last year in one case, I did a transactional funding where the net profit to the investor was $400. I made more money than he did. Why was that? Because he had to do a double closing. He didn't know that beforehand. He assumed, because of all the YouTube videos he watched, that you can assign any contract. Well, you can't because either the seller won't allow it, the profit's too large, you don't want the seller, the end buyer, to see how much you're making. The end buyer won't allow it, which is true in many cases with institutional buyers, iBuyers, hedge funds, so on and so forth. The state or the closing agent or attorney won't allow it. I can help. After thousands and thousands of closings, I'm your go-to guy to help you get deals done. I am besttransactionalfunding.com. I'm Dave Dinkle. My number is 954-274-1003. And I wish you limitless success in all you do, and keep your eyes and ears open if you're going to do a hard money loan.